evening, everybody. Thank you all very much for coming. And welcome to Energy-360, the Stanford Energy Club's quarterly event. Now, tonight, we've got a particularly exciting topic. We're going to be exploring the various stages of investing and what's required to convert energy research into the next impactful company, into the next Tesla. Our panel session is going to evaluate how investor goals and investment horizons change through the different investment cycles and how these affect the entrepreneur. Now, we're extremely privileged tonight to be welcoming a panel of experts in this field with expertise across the spectrum, ranging from seed investing to growth capital to private equity to project finance, and coming from some very visible firms, from TPG Capital, from Lake Kraftwerk, and from Khosla Ventures. In just a moment, I'll let the panelists introduce themselves, but before I do, I'd like to introduce our moderator, Professor Ryan Orr, and I'd like to thank the four of you all very much for coming today. Professor Orr teaches global project finance and infrastructure investments here at Stanford to engineering and business students alike. He advises several pension and sovereign wealth funds, and he is the founder of Zombato, which is a tech platform for infrastructure asset class. He got his PhD here at Stanford in engineering, and his advisor was actually Douglas North, Nobel laureate in economics. So without further ado, Professor Orr, I'll let you take it away and introduce our panelists.
Thank you. I think we have a terrific opportunity here today with a fabulous panel. At Stanford, we often lose sight of the enormity of the energy and infrastructure markets. A lot of focus on internet and tech and so on. But I think that infrastructure and energy is a very large opportunity set globally. And we'd love to realign the interests of the student body with this enormous market opportunity. But in a way that's cleaner, greener, and more sustainable for future generations. So as you know, there are huge companies in this space, Exxon, General Electric, but sometimes when you look at the size of these companies, it's tough to know how students can play. It's tough to know how Silicon Valley can play. And so I think it's fitting that this week at Stanford is Entrepreneurship Week, and we have panelists in this space who are very active at different stages in the investment cycle to help us address some of these questions. So the concept of the panel is to discuss different stages of the energy investment cycle. So we have Pierre Lamond with us. Pierre worked as a founder of National Semiconductor with Gordon Moore, so really is one of the fathers of Silicon Valley. Was at Sequoia for many years. More recently has joined Khosla. We have Tiffany Clay at TPG Capital. Tiffany was a graduate of Harvard Business School, was at McKinsey, is on the board of the World Resources Institute, and joined TPG in 2008. And we have Josh Raffaelli on the far side, who's at Lake Kraftwerk, and prior to Lake Kraftwerk was at DFJ, and was very active in Silicon Valley, diligencing many of the different subsectors of new energy technology. Is a graduate of the Stanford Graduate School of Business, and also spent some time at Oxford in London. I think what's interesting about our three panelists, Khosla is, tends to be an earlier stage investor. Lake Kraftwerk tends to be growth equity, and TPG, at least how it's historically known, is later stage. So I think we have perspectives, over the life cycle of energy investment. So without further ado, let's get over to our panel. Maybe the way to get started is if each of the panelists could talk a little bit about their firm and their firm's investment strategy in energy. So maybe we'll start with early stage. Pierre.
Okay, well, I'll tell you a few words about Khosla Ventures. That the firm was started a few years ago. We have two main funds, each of one is $1 billion. But one thing that distinguishes us from other venture funds is we have, in parallel to the main fund, we have a seed fund. We have two of them now, each one of them $300 million, where we make very early stage investments. And as Vinod Khosla likes to say, some of those are science experiments. We will do an investment as low as $250,000 to get somebody to basically develop a business plan, to $2 million or maybe $4 million, but we will not make an investment of $10 million in that fund. And the idea is that we take a lot more risk than we would in a regular fund. And if something works out, then the bigger fund will participate in the next round of financing. Needless to say, to be able to invest very early stages, you need to be more than just investors. You need to be very knowledgeable in technology, and we look for people in our firm that have a very strong technical background in different fields, materials, electrical engineering, scientific backgrounds in general, including actually in healthcare devices, not biotechnology. Because the very early stage company needs not just the money, but they need real mentoring. You can think of yourself here, sitting around here, starting a company. I'm sure not many of you have, or if any, not many have an idea of how to run a company, how to hire people, to even write a business plan. So we are trying to be real mentors to these early stage companies. We invest, from a dollar point of view, about a third of our investment go into clean tech in general, taken sort of. We invest in energy, in storage, we invest in a number of things of this type, but I have to tell you, and this might create some discussion later on, that our position is that right now there are no investments to be made in solar. There are no investments to be made in wind. So where do we invest? Well, storage is an area that continues to be of great interest. We have a few investments in batteries, and also an investment in compressed air storage. But there are some other ideas, and we're looking for new ideas in storage, because we think it's going to be a very important part of the whole energy landscape. We're also looking at other areas that, well, I forgot to mention efficiency, smart grid. That's an interesting area. However, I have to say that at Khosla Ventures, we have not made any, I think we've made one investment that you could qualify as being in the efficiency field. We haven't found attractive investments, because we don't invest just in technology, we invest in a business. I always like to say to technical people that people don't buy technology, they buy product. They buy product because they have a need, they have pain. The technology may be very elegant, but that's not enough. So there are other fields, by the way, that in our opinion belong to clean tech. It's maybe too great an extrapolation, but we think that there are opportunities in agriculture. And actually we invested a couple of years ago in a startup called Solon. Maybe some of you know it. It's a company started by a few Stanford grads. I think they were in chemical engineering or something like this. But basically it is a real-time measurement of nitrogen in soil, so that you can measure the amount of fertilizer that you need. And this company, which was, as I said, started about a couple of years ago, is doing very well. They are getting a lot of traction in the field. So agriculture is an area, and we have some other investment in agriculture. Some of them I'll be willing to talk about, some others I won't be. But we think this is an important area. Water is another very important area. Somebody, I don't know who said that, but somebody said that water is the oil of the 21st century. We're running out of water. conserving water, cleaning water, and so on and so forth. That's a great interest to us. And I've talked enough.
Sure. Thank you, Pierre. Pierre, how many companies are in the Khosla, across the different funds? How many portfolio companies do you have?
In clean tech?
Clean tech and then generally.
In general, about, I would say, 150.
Wow, so big portfolio.
Yeah, and in clean tech, about 70, maybe. I joined the firm in 2009. 2009, 10, and 11, we made quite a few investments in clean tech, but it has slowed down considerably in 2012.
Maybe we can come back to that a little later on.
At the risk of boring you, I'll tell you one thing that's interesting. The clean tech investments in 2012 amounted, this is venture capital, amounted to about $2.2 billion. In 2011, $3 billion. The one thing you'll be very careful of is that a lot of that is biofuels. There are still, believe it or not, people investing in ethanol. And that's, somebody lifted their hand. You're investing in ethanol? Good luck. I'm not a great believer. Then you have some interesting changes, like in 2011, $379 million in fuel cells. I'll give you one guess. Which company? Don't know? Bloom Energy. They are the company that raised a lot of money in 2011. So you've got to be careful when you look at statistics and try to dig in a little bit to see what really is going on.
Terrific, thank you. Let's go to our growth equity platform, Silver Lake Kraftwerk, Josh Raffaelli.
Great. So Silver Lake Kraftwerk was founded about a year and a half ago on the thesis that really there was a vacuum in the opportunity for companies that were invested by our colleagues at Khosla Ventures and a variety of other venture firms in the growth stage in energy and resources. What we do is we invest in innovation in growth companies in the energy and resource sector. So what that means, we're looking for businesses that are north of $20 million in revenue on a trailing 12-month basis. We're looking to invest somewhere between $25 million at the low end up to $100 million in capital, and really looking for businesses that are scaling and looking for that growth round as the last round of capital prior to a liquidity event. As we look at that space, we think that it's a very fertile space to be investing behind, whether it's in clean tech, as which we can talk through later, or all the way through traditional oil and gas investments and traditional energy investments. If we look at the amount of capital that's gone into the sector, just the clean tech sector alone, more than $50 billion of capital was invested in the last decade. 2/3 of that capital was deployed, it's pre-IPO capital, was deployed in wind, solar, and biofuels. So there's about 3,000 companies that are represented in that sample that we're looking at and tracking and evaluating and trying to find actionable opportunities behind. I guess the other thesis to point out is that we believe that that capital has been well spent. There has been good businesses that are coming about, and there are market leaders that are starting to develop. Our first investment, which we led about a year ago, is a company called Solar City, which is a solar investment, mainly a business-focused business model innovation, which went public in December of this year. We will continue to keep focusing on those market leaders and investing that type of capital behind those market leaders as we really try to expand this category.
Josh, one aspect that's interesting about your career, you started at EFJ here in Silicon Valley, looking at early stage, maybe 6 to 7 years ago.
Yep.
And now you've migrated, to a growth equity platform, and you've raised, what, $500 million, $1 billion approximately, and are out in market raising more.
Yes.
And so you've been able to leverage all the knowledge of the vast pipeline of, hundreds of companies at the early stage, kind of tracking your career into now the growth equity stage. Maybe you could just comment a little bit about that.
Yeah, well, I think it's a tough space to invest in the early stage today. And again, we'll designate that there are differences between clean tech investments, which have really been spearheaded by a lot of Silicon Valley venture capital firms, and traditional energy investments. Focusing on the clean tech side, there are not a lot of early stage opportunities today. It's a challenged category. Pierre is exactly right. Looking at solar's not an innovation game today, it's a balance sheet game. And so that's not well suited for an early stage venture capital fund. So I think that there are interesting opportunities potentially on the periphery, energy efficiency, some ag deals, a variety of other sectors, which are good investments, I think, for early stage venture capital firms. But on the whole, my desire was to look more towards how do you take these small companies that have retained some venture dollars and really help them scale. So that's been a transition that I've watched from, I guess, 2006 to today, and it's been an interesting one.
Maybe just one kind of further comment on that. Would you say you have a leg up as a growth equity investor because you've been tracking a pipeline of 3,000 plus companies from the earliest stages?
That's a layup. Oh yes, we definitely have a leg up on the company. It's helpful to have that background, but I think it's something that
It's an interesting career strategy to track the
Thanks, Ryan.
Josh is a former student, so
I see.
How's your favorite student?
very good student. Tiffany, TPG.
Yes. So I'm Tiffany Clay. I'm with TPG. I actually have a question for you all before I say anything about myself about TPG. What percentage of you, I want to see a show of hands, are optimistic about the opportunities in clean energy? What percentage are not optimistic? Come on, be honest here.
And why not? To put you on the spot.
Yeah.
Just the traditional.
I admire your courage.
Traditional energy right now is just it's hard to compete on price with natural gas for the foreseeable future. And so, if you're talking about actual generation, these other things that you guys talk about are interesting, but actual generation, clean tech just doesn't seem like it's the next thing in the next 3 to 5 years.
Yeah.
It's a fair rebuttal. And over here,
Oil companies dominate now.
oil companies dominate now.
Yes. Yeah. Very true.
I think it depends what time horizon you're looking at.
Yeah.
If you're asking about 15, 20 years from now, then I would say you got a great shot.
Right. Yes, I very much agree with all of those comments. I think, although I am an optimist, I would raise my hand in the first category. I think it is going to be incredibly challenging over this next 5 to 10 year period because of all the factors you mentioned. First and foremost being natural gas, particularly here in the U.S., right? When you're lowering the levelized cost of electricity, it makes it very difficult to compete with new technologies. So I totally agree with that. I think obviously the incumbents have a huge amount of capital, and the extent to which you can compete with that is very challenging. But the reason I say I'm an optimist is because I do think that there are a lot of sort of a long history of early stage technologies that have worked their way through, and a lot of early stage companies that are kind of on the verge now of getting to the point of commercialization in different sectors. If they get to that point, that's where the real opportunity lies. So I'm an optimist, but I recognize the naysayers in this room, and I'd say probably this room is not representative of the broader population, which is a problem. But anyways, in terms of TPG, TPG is, you probably know, is a global private equity firm. We have 17 offices all around the world, about 200 investment professionals. We were founded in the 90s, mostly as what you call now a leveraged buyout shop. Sort of a shop that goes in and does what Mitt Romney was so criticized for in the campaign in terms of doing leveraged buyouts. Over the years, though, a number of other ancillary platforms have built up at TPG, including a growth equity investing vehicle and a venture capital vehicle called TPG Biotechnologies, which is really focused on looking at opportunities in the biotech space. I work within actually TPG Biotech, which when you think about clean tech and the relationship, some of you might be scratching your head, but I can actually explain. I think there's quite a close correlation, and that correlation actually I'd say goes all the way back to the 1980s. When the biotech revolution first happened, what made it so successful, arguably, from a historical perspective, was the relationship between early stage biotechnology ventures and large corporates or pharmaceutical companies. Which, when you think about the history of it, it was really that kind of combination of large strategic / corporate interest and sort of more innovative early stage ventures that really led to the creation of an ecosystem of innovation within the biotechnology space, which we are now hoping is happening, and I think you see see a lot of evidence of that happening within the clean energy space as a result of growing engagement on behalf of strategics. So I think the strategics incumbency is an issue, but it's also an opportunity. It's an opportunity that we're focused on trying to capture. So more explicitly in terms of what we do, we have a new fund that we're currently in the process of raising, about a $350 million vehicle that will invest in alternative and renewable technologies. It's called TPG ART. We are focused kind of across all those stages in the chart that we just saw, which is kind of different in the space. A lot of people focus on just one area. We really want to play across the life cycle of companies by being able to do early stage, almost seed or early stage, round Series A and Series B investments, all the way up to being able to do the first commercial scale facility. We believe that's necessary because when you talk about some of the main challenges of clean energy, it's really around this quote-unquote valley of death that so many people have talked about. And that's the challenge, is really trying to find ways to de-risk the capital intensity of the innovation process in clean energy. So we're focused on doing that and are very optimistic.
Terrific, thank you. And how does your work at the World Resources Institute tie in? Tiffany?
Yeah, well, I'm on the board of directors of the World Resource Institute, which is one of the leading environmental think tanks. It's kind of like the Brookings Institute for the environment. So I think there's a lot of overlap between the policy world, obviously, and this sector. I think you find that in healthcare, you find that in energy, probably more so than any other sector. So really understanding what's happening at the policy level is critical. But having said that, you cannot have successful businesses in this space with strategies that are dependent on government support in the long term. You really have to find ways to be free of kind of government dependency. Otherwise, you can't build a sustainable business.
Terrific, thank you. If I can ask the panel, we've been through this 3 to 5 to 7 year wave now of clean tech, and we've faced some challenges recently at the earlier stages. What have some of the lessons been, thus far that we've learned as an investment community, and how do those lessons affect how we'll make investments going forward? Maybe Pierre, you can have your perspective.
Well, first I'd like to make a comment on what you said, Tiffany. Not every country in the world has the same amount of natural gas that we have. And so when you think clean tech, you can't think United States. Plus, this country, by and large, I've got to be careful with me, I need a bodyguard, but this country, by and large, doesn't believe in climate change. They may believe it, but it's more like a philosophical thing. They don't want to make the effort. But some other countries don't have natural gas, and some other countries are really concerned about climate change. So, I fall into the rank of the optimists. I think that some of the other points you made are absolutely clear. It's difficult. The financing of clean tech is very difficult. The Solyndra and A123 effect is really a problem. I assume you know what Solyndra is or was. And A123 was not helping either. So it makes financing, second round financing, very difficult. So what we find is that we can do a seed financing, we'll do the A round by ourselves in many cases, but when the company starts needing real money, so to speak, it gets to be very difficult. And the reason of it, frankly, is and the interesting thing is the Solyndra effect has an impact on all of clean tech, at least in our
Can you articulate, Pierre, what you mean by the Solyndra effect? I presume you mean Wall Street and analysts throwing out the baby with the bathwater, in that we had a failure that's been prominent that causes...
We can go into great details of why Solyndra failed, but the fact is they failed. Right. A123, it's a battery company that, full disclosure, I was an investor in the first round. I didn't follow after that. But, they went public at about $1 billion valuation and went bankrupt. So, you go to somebody now and you say, well, I have this battery company, great technology, et cetera, et cetera. We need $20 million to go, the next step, very difficult to do. So in our case, for many of our companies, we're turning to markets outside the United States. And the first one that comes to mind is China. There's a great need in China for all sorts of clean tech technology for many different reasons, and they're very open to investing in the clean tech area. They have some of the largest wind companies in the world. They have some, they have destroyed the PV market by themselves because of overcapacity. But